Alright, let's get one thing straight right now. The stock market is not a casino. It is not a lottery ticket. It is a powerful tool for building wealth, but only if you respect it. And respecting it means understanding the two most important words in investing: risk and return. Think of them as two sides of the same coin. You cannot have one without the other. So many people I talk to are terrified of the word risk. They hear it and think, losing everything. But that's not what risk is. Risk equals the chance your investment's actual return differs from expected. It is uncertainty. It is the possibility of your money going down or going up. Return is the money you make or lose on an investment. It is your reward for taking risk. Example: buy $100, sell $110. That's a $10 return, a 10% return. We invest so money works for us and grows over time to reach goals. Secure retirement, a down payment on a home, financial freedom. People want all return with no risk. That is a fantasy. Promised high return with no risk? Run. Major red flag. Risk and return are linked, the core of investing. Avoiding risk entirely only destroys value through inflation. Goal: understand risk, manage it, and take the right amount for the return you need. Now that we know what risk is, let's get a little more specific. Not all risks are created equal. In investing, we basically have two main types: systematic risk and unsystematic risk. Systematic risk weighs down the whole market. Unsystematic risk affects a single company or industry. Systematic risk is the big stuff: recession, interest rate spikes, geopolitical conflict, pandemics, events that can pull the entire market down. You cannot eliminate this risk. It is part of the system. Unsystematic risk is company-specific. Maybe a product flops, a CEO scandal, a strike, or a new competitor. Those hit only one company or industry. The good news: unsystematic risk is manageable. The answer is diversification. Do not put all your eggs in one basket. Spread your money across many stocks, sectors, or use an ETF to get instant diversification. But diversification cannot protect you from systematic risk. When the whole market drops, a diversified portfolio will likely fall too, perhaps less but still impacted. Understanding which risks you can control and which you cannot is critical for making smart decisions. Protect what you can, diversify to reduce company-specific risk, but plan for market-wide shocks with allocation, cash reserves, and a long-term horizon. Diversify, prepare, plan. Let's talk about the trade-off. This is the heart of it all. There is a direct relationship. Generally, higher risk means higher potential return. Lower risk usually means lower returns. Think of it like a ladder. Very low risk, U.S. Treasury bonds. Low return, high safety, very high risk, small cap growth stocks. They might 10x, 20x, or even 100x, or go under. This is the risk-return trade-off. You cannot get high returns without accepting higher risk. Your job: find the right balance for your goals and comfort. Use safer investments as a foundation, bonds, cash, then add riskier assets for growth. Build a mix that aligns with your time horizon and tolerance. Ask two questions. 1. What is the potential return? 2. What is the risk I have to take to get it? If you focus only on returns, you are investing with one eye closed. True power comes from understanding both sides. Make conscious, informed decisions willing to accept potential downside for potential upside. That is what being a smart investor is all about. Before you invest a single dollar, do some soul searching. You must understand your personal risk tolerance. How much volatility can you stomach without panicking? Do you sell on a 10% drop or buy the dip? Your emotional reaction matters. Key factors: time horizon. How long until you need the money? If you're 25, you can take more risk than someone retiring in 5 years. Short horizon, less risk, period. Your financial situation, stable income, and an emergency fund, 8-12 months, let you ride out drops without selling. If a job loss would force you to sell, you cannot take much risk. Finally, your personality. Are you a worrier who checks balances daily, or are you laid back? Be honest, there is no right or wrong. If you panic easily, build a more conservative portfolio even if you have a long horizon. The best plan is one you can stick with. Use consistent monthly investing, automation, and a plan you will follow through. Be honest with yourself and write your plan. Discipline beats bravado. Assess time horizon, financial stability, and emotional makeup. Then build a portfolio you can live with. I've seen it all. People repeat the same mistakes over and over. Biggest mistake, letting emotions take the wheel. Fear and greed. When markets soar, greed and FOMO make people pile into risky investments at the peak. Then the market corrects, fear sets in, and people sell at the bottom. Another mistake, trying to time the market or waiting for perfect conditions. You often miss the best days. Putting all your eggs in one basket, concentrated positions, employer stock, can be catastrophic. Diversify across companies and asset classes. A balanced allocation prevents single-event disasters. Paying high fees is a silent killer. A 1% fee compounds into huge lost returns over decades. Look for low-cost index funds and low-fee ETFs to keep more of your returns. Antidotes. Have a written plan, automate investments with dollar-cost averaging, and avoid chasing hot tips. Invest consistently, and let time do the heavy lifting. Discipline and patience beat noise. Summary: plan, diversify, minimize fees, and control your behavior. So there you have it. Risk and return demystified, not as complicated as it seems. Risk is uncertainty. Return is your reward for taking it on. Higher risk, higher potential returns, balance with your goals. Look in the mirror and assess time horizon, financial stability, and your emotional makeup. Build a plan that lets you sleep at night. Armor up with diversification, dollar-cost averaging, and a long-term perspective. Use low-cost index funds and automate monthly contributions. Do not check your portfolio every day. Ignore noise. Trust your plan. Start today. Write a simple plan, open an account, make your first investment, however small. This is your money, your future. Be deliberate, be disciplined. You can do this.